Hey guys, before we get started with the market update, let me direct your attention real quick to our end of year super sale. We're going to offer RapidQuants Unlimited, which is our options offering. It usually goes for $149 per month, and we're going to offer it all through December as a special deal for only $597 if you sign up for 6 months, or $997 if you sign up for an entire year. That's a massive discount, and if you're interested, shoot me an email at mike@rapidquants.com. The sign-up page for that should be up and running in a day or two, but in the meantime, shoot me an email to mike@rapidquants.com if you're interested. See you on the other side. Cheers. Welcome back to this Mike with Rapid Quants. It's November 30th, 2022. Time for market update. Last trading session of November. We're heading into the holidays, and I could use a rest for sure. It's been a crazy year. Look at these huge gyrations here. And if you compare this market, and it almost started at the dot here when the year rolled over. If you compare this market with last year, with 2021, what a beautiful bull market advance, low volatility, a little bit of drama here in between, but this looked big back in those days. And even the summer shakeout was comparatively mild when you look at the price action we had to go through, that we had to endure over the last year. But it quickly recovered, burned all the shorts as usual, and advanced then all the way into all-time highs at the end of the year. And almost at the turn of the year, it rolled over along with the price action. And I mean, look where we are now. With 14% down, doesn't sound like much, right? We're not even officially in bear market territory yet. Well, we were briefly, I think, but we're not yet. And now where we go from here, of course, is anyone's guess. But if you're looking in retrospect, this looks very predictable. But it's been a difficult year for directional trading. A lot of people have gotten shaken out. In hindsight, everything looks very clear here, right? And this channel seems to be building. Even if we push a little bit higher, there's very little upside, I think, left here. Upside potential is possible, but the downside potential is, in my opinion, much, much higher. And if you're looking at the VIX, for example, you might remember, if you've been following me for more than a few months, then you might remember that last summer, not actually the summer of 2021, so previous summer, I already started looking at this as a potential baseline because we were working our way down here and we were really low. This was a great time actually to start hedging yourself in terms of implied volatility. And so we were working our way down, and then something changed and we got these first few spikes up and the baseline started lifting, and it has continued to do that ever since. Look at this, right? This baseline has worked its way up and it's now produced this megaphone pattern. It's always harder to draw a line on the upside when it comes to the VIX. Why? Because it's not normally distributed, right? It's always much more wild, right? With the outliers, it always looks much wilder on the upside. So it's very hard to always and ever draw a line here, actually. On the downside, however, you can often really discern where support really kicks in and where it's bound to snap back. And we're already seeing that a bit here, right? If you're looking at the right side here, we're really seeing a little bit. This has kind of bottomed out, it looks like to me. Yeah, okay, we might, try to drop a little bit below 20 one more time, but we haven't spent much time below 20 this year. Look at this. We're in April and in August. So when traders came back to work, right, after some downtime, things got wild again. And I think this is probably what we should expect moving forward. What really, really is interesting, though, if you're looking at the volatility of volatility, and this one I've shown in my last market update, and let's go to max because I really want you to see what I'm talking about here. And so this is monthly, obviously. Let me tell you, this is historically low. A reading like this in the market conditions that we're in right now, it's outright scary because honestly, we shouldn't spend any time down here. We should be up here. And the fact that we're down here is concerning. It seems to me there is a lot of complacency in the market still. And there still is the expectation that the Fed will cave eventually. And, well, I have my doubts. I really don't think so. This is building a base here already. And I mean, how low we're going to go here with the VX, because we've had very little movement. And when movement kicks in again, and it will at some point, things going to go crazy. What else is going on? Well, let's look at the XRT real quick here. Obviously, retail, but retail ETF. And well, so let's talk about this. Yeah, we had a little bit of a bounce here. But if you're looking historically, right, I have my little statistics tool here. If you're if you're a subscriber, then you probably know this. But I've built this tool many, many years ago. Let me resize it properly. Because I didn't see anything out there that was giving me the same thing. And so I had to build it myself, as I usually have to. And what I wanted to know, how current price action ties into what happens historically, right? And historically, well, it kind of has shot its load here, right? Because November is usually a pretty strong month, actually, for the XRT for retail. And so I think, if you compare that with December, it's kind of meager. There is more upside here that we can anticipate going into early, next year. But for now, and let's look also on the weekly here. See right here, this big jump, that's a Thanksgiving jump. And that's really that's actually the strongest week of the year, to nobody's surprise, of course. And what else? Well, if you then look at XLP, let's look at that one real quick. Right, XLP here. And in the meantime, I'm going to pull it up over here on the chart as well. Right, consumer stables basically, and it's a similar story, right? We had, as expected, you would have strong October, November. A lot of shopping occurs there. And if I go down here, we've got tons of stats, by the way. Sharp ratio and skew and all that. If you are a statistics nerd like I am, you're going to love this. But just looking at weekly percent change, that's usually what I look at. And also, skew. And most important, let me look here. Right, Sharpe ratio. That's probably what most of you guys are most familiar with, right? So we're calculating here the Sharpe ratio since 1999. I always pull all the data that I can. And well, it's one of the strongest of the year as well. And you can see that here already in December, we should probably expect a drop. And when you look at this here, well, this might be a great place to go short. Maybe, load up on some spreads, or maybe sell some premium up here and down here. This might be a good way to go. So this is definitely some of the sectors that I'm looking at. Retail, because I think it's shot its load by now. So what else? XLU. Utilities, right? You would expect, and let's talk a little bit about energy, right? We're going to also look at XLE in a second here. But in terms of utilities, no surprise we're seeing a jump here. 'Tis the season, but I think it's actually quite weak. We should be ramping much harder here at this point, especially given what's going on. Compare that with XLE, for example. Let's go there real quick. Yeah, I mean, this is what I'm talking about, right? It's holding pretty strong. It's all-time highs. And when you compare this, XLE, with XLU, again, utilities, I think this is probably the one you want to play, long XLE and short XLU. That's probably a play that might be interesting. What else is going on? Well, let's briefly talk about what's actually been dragging down the market and look no further than, let's say, the cubes here. What's interesting here, this doesn't look exactly encouraging, but if we look at my synthetic index, this is actually a synthetic that I put together, what I call the monsters of tech, just the leading symbols, right? If you compare that, usually they're the ones that hold up the market, right? And I'd say we're not seeing that at all. We're seeing that the monsters of tech are, I'm not sure they're leading down, but they're definitely weakening. And it's just looking ugly in tech. So compare that with, for example, if we're looking at XLF, finance. And well, again, that's kind of what's been holding up the market. If there was any upside, most of the action really came here out of finance. And I wonder how long they can keep that up. I mean, we're already running into a little bit of a wall here, right? If you kind of look at this here, right? Let me draw a line real quick. Are we going to pump a little bit higher? Yeah, it's possible. But I think, again, with what's going on, if you're looking, for instance, here, look at the TNX interest rates. Dropped a little bit, along with the dollar lately, by the way. And you know what? Looking at the 10-year future, CN, that's most what institutionals are trading. Normally, the 30 years, a lot of retail traders looking at the 30-year. Institutionals more look at the 10-year. And yeah, a little bit of a pop here, but we've seen that before. It's very meager. If you compare with how the dollar has been slammed over the last month or so, I mean, talking about a fall from grace. Look at here, 115 almost, and we briefly scraped 104. So looking at the Euro USD, I'm like, what the hell is going on? I mean, Europe is really in trouble. Europeans don't even know how to heat their homes, let alone run their economy this winter. And next winter is actually almost guaranteed to be worse. So I'm not sure what the euro is doing here at 104, but I think it will be short-lived. I don't see this euro going to 110 or even higher anytime soon. I think this might have played out. Let's see what happens. Today's Fed day. Let's see what happens. I think people are already nervous. This kind of tug of war, right, between dovish and hawkish, even inside the Fed. I think it's all kabuki theater. I think they know exactly where they're going. I think, painting the market a little bit higher into the holidays, especially also prior to the midterm elections. With that now behind us, well, I think that there's going to be a big shoe to drop early in 2023. If you look here, we're at a similar situation. Late last year, but they pumped it into the close of the year and then it kind of fell apart from here. So I think it's going to be an interesting year, 2023. But have no fear, I'll keep you ahead of the game. I have you back. I project forward. I give you the probabilities as we go along. You cannot plot along for more than a few months at this time. That's really the max you can do. You can trade only a week or two ahead. Long-term trading, that's out of the window. We play the swings. We play on volatility. We play on time. And market direction, it's not going to be the game. So that's the stuff that we do at RepoQuants. That's what we're really good at. We've been trading very well throughout all this. And there's a reason for that, because we're not doing the one thing that basically doesn't work anymore. It has worked over the last 12, 13, 14 years, but those days are over. And the sooner you appreciate that fact, the better you will do in the market, the better it will be for your account principal and for your trading reality. Okay, that's it for today. I'll see you all next time. Cheers.